All right. All right. Welcome to another public live stream session. And man, am I super fired up to talk about the HSA or Health Savings Account. So let me make sure that the audio is working great. So the audio is working great. All right. So anyway, this is going to be about HSA today. So we all know that the benefits elections are coming up for most employees in November. So I want to make sure that you're aware of the 2026 HSA contribution limits and how you can take advantage of the tax benefits that come with the HSA. And if you have questions about the HSA, be sure to put them in the live chat. And I already got questions from my private community, and I'll go over those after going over the 2026 numbers. And if you're interested in joining my private group, you can go to firesidechat.com/community. And we have a specific chat that is for HSAs. So first things first, for those of you with self-only coverage under a high deductible health plan, which is the fancy name for an HSA eligible plan, the limit is going to be jumping to $4,400 in 2026. And that's a $100 increase from 2025's number for $4,300. And for those with an HSA family plan, that limit is going up to $8,750. That always pisses me off how they never align. Like, why not just do an 8,800, but they're going to go with 4,400 for the single, but family is 8,750. It's kind of the pain. But anyway, besides the point. But that's a $200 jump from 2025's 8,550. And did you know that an HSA also comes with a $1,000 catch-up contribution? So that's going to be $1,000. But it's just like the Roth IRA. But keep in mind that you have to be at least 55 years old, or if you're turning 55 sometime in the same calendar year. So if you're 54 right now in May, but you're not turning 55 until December, you can still put that extra $1,000 into the HSA because you're technically 55 in the same calendar year in the eyes of the IRS. That makes sense so far, right? So that works the same way with the Roth IRA as well. So if you're going to be 50 in the same year, you can put that extra $1,000. And what's really awesome about the HSA is that you can get an employer match like your 401k. So some state government and I know some federal employees who get a match through their healthcare plan. Okay, so what if they get an employer match for a single plan? So you are single and you get a $500 match or contribution or pass through from the healthcare plan. So now the extra 4,400, you're going to have to subtract 500 from that 4,400, and that's going to give you $3,900 because you cannot exceed the contribution limit. It's not like the 401k where you get to contribute to your employee portion and then the employer gives you an extra. You actually have to account for the overall contribution limit because 4,400 is the contribution limit between you and the employer. Okay. And then let's say for the family plan, you have 8,750, right? That's the maximum. And you get an employer match or some kind of pass through, then you have to subtract $1,000 from 8,750. So the maximum that you can contribute is actually $7,750. So when you log into your HSA account, if you're getting the match, let's say that is going to be other than what you contribute, that's what you want to write down. So if you don't know that, you should be able to review the pamphlet that you got last year or this year. Some people have like a weird benefit election, like they go from June to June instead of December to December. So you need to kind of read up on what they're offering from there. Okay. And just keep in mind that when you make the contribution, you also have to reduce your contribution bi-weekly. So what that means is that if you get paid bi-weekly, or if you get paid on the 1st and the 15th, or once a month, whatever that is. So you have to base off of that. So if you're a single and you're making, they're giving you that $500 match, you have to divide that by 26 if you get paid bi-weekly, so $150. So if you didn't have that match, it's pretty simple, right? So you just do 4,400 and divide it by 26, and that's going to give you $169.23 every paycheck. What I always recommend is round that down to 169 because most HSAs don't stop you from over contributing if you pay it directly out of your paycheck, because you got to remember that that's more like a what do you call that? An allotment going into the HSA. So when you put $169 and let's say 27 cents, it's just going to be transmitted to your HSA, and the HSA doesn't have that power to kind of stop that from transmitting. Now it's going to be flagged as an over contribution. So please keep that in mind. You have to be very careful with that. Okay. So I always recommend that you round it down. If you have like let's say $169.26, just round that down to 169. All right. And the same thing for married people. So if you're married, let's say 8,750, you get paid bi-weekly. Remember, it's 26 paychecks in a year. Then you can do $336 per paycheck. And if you get an employer match, so then you can just do $7,750 and divide it by 26. And that gives you about $298 per paycheck. So if you're getting paid bi-monthly, so that would be on the 1st and the 15th, simple. You just do $7,750 and then divide it by 24, and that gives you $322. Okay. Even if it says 92 cents, you always want to round that down because you don't want to over contribute. If you get paid on a monthly basis, then you just divide it by 12. That's pretty easy, right? And that gives you about $645. That makes sense so far, right? So here's some additional numbers that you need to know. Okay. So first, there's the maximum out-of-pocket maximum annual out-of-pocket expenses. So this is the most you have to pay in a plan year for covered in network services. So think deductibles, co-payments, co-insurance, but not your premiums. So for self-only coverage, the limit is increasing to $8,500 in 2026, which is up from $8,300 in 2025. And for family coverage, it's now $17,000, up from $16,600 in 2025. And this is your safety net. So your financial ceiling for medical costs within a given year. Okay. Then there's the minimum annual deductible, which means the amount of money you pay for healthcare expenses and services per year before your healthcare plan starts to pay. So for self-only coverage, the minimum is ticking up to $1,700 for 2026, which is up from $1,650 in 2025. And for family coverage, it's rising to $3,400, and which is up from $3,300 in 2025. So again, this is the amount you typically have to pay out of pocket before your insurance starts to kick in for most services. And here's another gem that you need to know, because a lot of people didn't know about this on the HSA. Okay. The HSA contributions, they follow the tax year, not the calendar year. So what does that mean for you? It means you've got until April 15th, 2027. That is the deadline to make your 2026 contributions. So it's the same thing. Your 2025 HSA contributions, you have until 2026 or April 15, 2026 to max out your 2025 contribution. It's just like your Roth IRA. So even if you forget to max out your HSA by December 31st this year in 2025, you still have a few extra months to catch up before tax day rolls around. And it's especially helpful if you get a year-end bonus or an early tax refund. Unlikely. And but if you want to funnel a little extra money into your HSA, you can do that. So by April 15th, let's say for this instance, 2026, you can still contribute to the maximum 2025 limit, which is $4,300 for the single, and then you can put in $8,550 for the family coverage. Okay, I hope that makes sense so far. And don't forget about the last month rule. Okay, so there's a thing called the last month rule with the HSA. So if you're HSA eligible, let's say on December 1st of a given year, you're treated as eligible for the entire year. So you can contribute the full annual limit, and just make sure you stay eligible. When I say eligible, it means you're still under the high deductible health plan. You stay eligible through the next 12 months. So from December to in the next 12 months, or else you'll owe taxes and a penalty on the excessive contributions calculated on the IRS website. So let me give you an example. So let's say you became HSA eligible for HSA on December 1st, 2025 with the family HDHP coverage. Okay. So under the last month rule, you can contribute up to $8,550 to your HSA under the 2025 tax year. So from that point forward, you're going to be under what's called a testing period. Okay. I'm going to write that out. So it's called a testing period, and which means that you have to be under the HDHP coverage for the next 12 months from December 2025 until December 2026. But let's say you became ineligible, okay? Ineligible for HDHP, let's say in June 2026, okay? Then you failed the testing period because you didn't meet that testing period between December 2025 and December 2026, which means the majority of that $8,550 that you contributed back in December 2025 will become taxable income with a 10% penalty. So if you divide, didn't mean to do that. So if you divide 8,550, scroll down, divided by 26, that's $328. And nope, it's not 26. Divided by 12. There you go, $712.50, right? So you're going to subtract $712.50 from the $8,550 that you contributed. So 8,550 minus $712.50, that gives you $7,837.50 will need to be in your gross income on your 2026 tax year, which changes your federal income tax, state income tax, and a 10% penalty. So I'm going to say this again. Because you failed the testing period, you can only contribute that $712.50 for December 2025, but the remaining, let's say the remaining $7,837.50, assuming that you put all 8,500, let me highlight that in red, assuming that you put all 8,550 into the HSA in December 2025, this will become taxable income by your state and federal, plus you get a 10% penalty, okay? And that will suck. So just be very, very careful with the testing period, especially if you're switching from the self-only or individual coverage to the family coverage during the first year. That could result in devastating consequences with taxes and penalties. And some people go through a divorce, or some people just get out of that plan, or your spouse has a change of healthcare plan. Just make sure to follow the IRS guidelines if you have any questions on the last month rule. All right. And please do not confuse HSAs. Here's the HSA and FSA. Two different things. I've seen this mix up so many times with my clients. So here's what you need to keep in mind. HSAs are yours to keep. You don't lose the money at the end of the year. So HSA is what we're talking about right now. Okay. It rolls over, it grows, and you can invest it. If you quit your job, you get to keep your HSA. If you retire from your job, you get to keep your HSA. I treat my HSA like a traditional IRA or a Roth IRA because I want my future healthcare expenses to grow tax-free in my HSA. And an average couple is spending about $350,000 in healthcare expenses throughout their retirement. That is crazy, right? But anyway, FSAs, on the other hand, let me use a different color here. So this is FSA, which is the flexible spending account. And this is a use it or lose it. There's a carryover limit of $660 for the FSA. I haven't seen the numbers for 2027, but I'll figure that out in a second. I don't think that one is coming out until next month anyway. But if you quit your job and you have a remaining balance on your FSA, okay, you basically donate that money to your employer. I'm going to say that again. Your FSA money, unused FSA money, let's say you have $500 left in there and you quit your job, it is going right back to your employer as a donation if you have a remaining balance. And you cannot use the FSA after your last day of work unless you qualify for COBRA continuation coverage. And I don't want to talk too much about the FSA in this video, but the bottom line is that HSAs are the MVP of tax advantage accounts with quadruple tax benefits. Okay. MVP like Danny Dimes, Indiana Jones. Let me know if you're a Colts fan. No? Okay. I don't think anybody's really a Colts fan. All right. So besides me, maybe. I'm a firm believer that the Colts are going to the Super Bowl and they're going to win it this year. That's just me. Call me a delusional fan. I don't care. But anyway, all right. And I need you to have a very clear understanding of how you become eligible to open an HSA. Okay. So it's very complicated, but I want you to understand the eligibility in order for you to open an HSA to contribute to it. Because if you don't understand the basics, you're not going to understand the changes. So to qualify for an HSA, you must be covered by a high deductible health plan or HDHP. If your healthcare doesn't say that, you're not going to be eligible for it. You cannot have any other healthcare coverage or be covered under your spouse's plan. So if you're a veteran like me, and let's say you're retired and you're on TRICARE, you're not going to be eligible for an HSA because it's not a high deductible health plan. TRICARE is not, okay? And if you're covered under your spouse's healthcare plan, that's not high deductible. Let's say your spouse is working a job and they get really good health benefits and your claim as a part of that plan, then you're not going to be eligible for an HSA. You also cannot be claimed as a dependent on someone else's tax return. And you also cannot be enrolled in Medicare. The big, beautiful bill that was signed on July 4th was supposed to change that, but the Senate pretty much removed the HSA provisions. I made a video about that. I was pretty upset on that. But anyway, you can use your existing HSA funds, though, however, to pay for premiums for Medicare Parts A, B, C, and D. And you just cannot contribute to the HSA while you're covered by Medicare. I know it's confusing, but let's say you're under Medicare, but you can use your HSA to pay for your Medicare premiums and expenses, which can increase your take-home income, pay for your Social Security retirement benefits. Okay. So that's a trick that most people don't know. And HSA laws, the HSA Act was actually passed in 2004 during the Bush era. And most people didn't even know about it. They didn't really use it. But, I do encourage people who are healthy, they have no issues with their health, to look into it. I don't tell them they have to sign up for it. But if that benefit is available to you, I strongly encourage you to take a look at it. Okay. So let me just demonstrate to you how FIRE investors do things differently with their HSAs from the regular people using their HSAs. Okay. There is no income limit. There's no income limit like the Roth IRA. So you don't have to worry about that. But remember how I told you that you're contributing to your HSA with pre-tax dollars, right? So every dollar that goes in to your HSA is in pre-tax contributions. So think of it like a traditional 401k, traditional TSP. You don't, think putting your money into your HSA like it's just like a traditional 401k. It lowers your federal and state income taxes. The only exception is if you live in a state like California and New Jersey. That means that you're only going to save on the federal income tax if you live in California or New Jersey, and not their state income taxes, unfortunately. Sorry. If you're watching it from California or New Jersey, let me know. But you're not going to save money on the state income tax, but you will still save money on the federal income tax, right? Now, so you put in, let's say, so my wife and I would put in $8,550. That was the family plan for HSA. That's also available for self-employed individuals too. So $8,550 that was put in. And let's say, what if you pay for the unexpected medical bill with your cash reserve instead of your HSA? So you can consider it a loan to yourself for the future, right? The thing is, as long as you keep the receipts, you can reimburse yourself from your HSA anytime. There's no expiration, even years later, 10, 20, 30 years, doesn't matter. What if you had to spend, let's say, $3,000 on an out-of-pocket medical expense, right? Let's say this is in 2025 that I did it. So I can reimburse myself that $3,000 in the future, in the year 2045 from your HSA, and use it for whatever you want. I don't want to touch my HSA because I want it to grow tax-free, right? So just imagine, let's say, how much that $3,000 could have grown in your HSA if you waited for 20 years. So I don't want to touch that $3,000 out of my HSA because I want it to grow tax-free. $3,000 in 20 years. Ready for this? with 8% rate of return, that is going to be almost $14,000. And the $11,000 in earnings, capital gains, or dividends are considered tax-free growth. So that's assuming that there's no additional contributions. Okay, it's just $3,000 in balance. In 20 years with 8% average annual rate of return, $11,000 of that is going to be in earnings. Okay, that's amazing. So again, the key is to leave the money in the HSA so that it can stay invested with an index fund, ETFs, or other mutual funds. If I took that $3,000 out, then it's not going to grow any further in the HSA, right? It's the same concept when you talk about Roth IRA. I have an emergency fund. I don't touch my Roth IRA because if I touch my Roth IRA, it's not going to compound. It's not going to grow as much as you want to, or as much as I want to. Same concept with the HSA. Just keep those receipts because that is the golden rule of HSA. So my wife and I save every single medical, dental, and vision receipt so that we can reimburse ourselves later with the HSA, regardless of our age, and take them out tax-free and penalty-free. Because if you don't have a receipt, the IRS is going to assume that it is a non-qualified medical distribution or a non-medical expense. Okay, so that $3,000, let's say I misplaced that receipt that you're supposed to get tax-free, it's now $2,400 because of the 20% penalty. I'm going to say this again. HSA has a 20% penalty, which is brutal. I mean, right pen. There we go. 20% penalty, not 10% like the Roth IRA 401k. They were pretty strict about this. 20% penalty if you misplace the receipt or if you withdraw your HSA for non-medical expense. That's right. Okay. So on top of that, you're going to owe federal and state income taxes for that $3,000. So you need to make sure the receipts are saved somewhere safe. I scan all of my receipts in Dropbox. All right. I use Dropbox as like a cloud service. They're pretty incredible. But I categorize them in numerical order based on the year, months, and days. So I write down like 2025. Today's what? October 7th. So I put 1007. And then I put a dash in between and I just write down, who the provider was and what it was for. So if I went to Costco Vision and I write down Costco Vision and I write down contact lenses, I wear contact lenses, right? So I wrote those down. So the downside is really just learning to organize your receipts so that you can get reimbursed in the future. If you're not about that life, then this hack may not be right for you. And as a business owner, I save all of my receipts anyway, so I'm really used to that kind of lifestyle, right? But here's a fun twist. Once you hit 65, that is the magic number. You can think of the HSA getting a major promotion. Okay, so now HSA sort of become a traditional IRA, right? It is no longer just a medical expense fund when you're 65. It actually transforms into a retirement account. And at that point, you can withdraw money for anything, vacations, home renovations, even a dream RV without worrying about that dreaded 20% penalty. And the only catch is that you'll have to pay regular income tax or non-medical withdrawals. On any non-medical withdrawals. So when you're 65, you can still take the medical withdrawals out. If you have to go see a doctor or a specialist, you're not going to get taxed on the qualified medical expenses. But when you're 65 and you want to use it to buy a motorcycle or you want to improve your backyard, you can take it out and you don't get that 20% penalty. You just get taxed by the Fed and the state. I live in Nevada, so I don't get that state income tax. So the only tax I would have to worry about is the federal income tax, right? So but considering you got all these tax-free contributions and tax-free growth along the way, it is still a sweet deal, okay? So I hope that makes sense. I'll be happy to answer some questions in a little bit. But now here's something else I want you to remember to do. Do not forget to name your beneficiaries for your HSA. I have seen so many sad stories. I did 20 years in the Air Force, and I've seen people who forget to designate the right person as their beneficiary, or not designating anyone at all. So it ends up going to probate, right? Someone still had their ex-wife listed as their beneficiary. And guess who that, where that HSA went to? His ex-wife. All right. It's sad when you don't take care of that part. By naming your spouse as the beneficiary, your husband and wife, whoever, not your significant other, not your boyfriend or girlfriend, your HSA going to your spouse actually just gets rolled over to your spouse's HSA. So if your spouse does not have an HSA, they'll create one for you. Kind of like, think of it like an inherited IRA, but they don't have a name for inherited HSA, but they're going to create that HSA for the spouse, right? And then that money will go over to the spouse, and the spouse does not pay any taxes on it. So if the spouse decides to be, or most likely will be, under the HDHP anyway, so that your spouse can continue to use the HSA tax-free for qualified medical expenses. However, and this is a huge however, if you designate a non-spouse beneficiary, let's say your child, because you're not married or you're divorced, or anyone in the family tree, you want to give it to your mom, dad, grandparents, or grandkids, they will receive the account balance as taxable income in the year of your passing, which provides them with immediate financial support, which is great during a challenging time. But that HSA could also raise their taxable income for the year. So please keep that in mind when you designate your HSA beneficiaries. So taking the time now to assign beneficiaries is a simple yet profound way to extend your legacy of care and support to those who matter most to you. Please do so. Please update your beneficiaries. I can't stress enough on updating your beneficiaries. And even if you're not a veteran, it's crazy how almost 55% of Americans do not have a will. Get a will. Please get a will. Write down, get a will, and just write down what you want to do. Even if you're healthy, I am healthy. I run like every day, taking care of my body. I'm always prioritizing my health, but I never know what's going to happen tomorrow. People in Vegas, they drive like crazy. I think one day one of them is going to hit me and then I'm gone, right? But I need to have that will so that my family, they're going to be taken care of when I'm gone, and they would know what to do. Okay. So that's really the key thing here. But just remember that when you designate a primary benefit, a non-spouse as a primary beneficiary, they're not going to enjoy the same tax break as your spouse. And if you're not married, it doesn't really matter. They're still going to have to pay taxes, because the entire amount that you put, all the money that you put into the HSA, that's all in pre-tax. So that's why. Okay. All right, let's go into the Q&As here. All right. Yeah. I love Fidelity. So my wife has Schwab with her HSA. So she works as well, and she has her own HSA, and I work as a self-employed, and I have my own HSA. But low cost index funds, either Fidelity or Schwab, if you get into the healthcare company that has a because you don't get to choose who you want to invest with, but if you happen to have a certain healthcare plan that has ties with Fidelity or Schwab, I don't think Vanguard does it, then you're going to save a lot of money on the investment fees. And they have some of the greatest low fee index funds, like Art of War was saying. Like they have the S&P 500 index fund. I think my HSA has a Vanguard S&P 500. So it's really, really cheap to just invest in that. But yeah, you can even do ETFs. You can do individual stocks. You can do index funds, right? I just keep it really simple. I just put mine into the index fund. I don't want to stress about it. All the fees, all the dividend distributions, capital gains, I don't get taxed on that because it grows tax-free. So yeah. Ron Moore saying that the Colts going to the Super Bowl in 2026. I don't know what delulu. Does that mean delusional? Man, you take that back, man. The Colts are going places. They're 4-1. They should be 5-0 right now. But listen, this is probably 30 years old. Look at all the dust it's been collecting. Ever since Andrew Luck left, it's like we've been in a depressed era with the Colts. All right. I even got a flag that was signed by Andrew Luck from 2013, 14, maybe. We haven't done anything. We started to turn to the Browns. The Browns they were switching quarterbacks like it's like every season. We started to get like different quarterback every year. I mean, I had I was skeptical about Danny Dimes, but I was used to it. But I'm really glad that the Colts are doing good. So, um, delusion or not, I got to be a fan. I do want to go to the playoff game if they do make it to the playoffs. I'm pretty sure they will. The Jaguars being 4-1, that was not on my bingo card for 2025. I'll tell you that. Jaguars looked pretty good against the Chiefs last night, but I hate the Chiefs. Yes, absolutely. It is the holy grail of savings account, a super Roth IRA. It really is. I mean, if you want to rewind back and talk about what I said earlier, throughout this live stream and probably in the first 30 minutes, please watch it. And then if you have questions on it, or if you want to have a consultation, you can go to my website, firesession.com/consultation, and talk about that. Okay. And sorry, I forgot about the private community here. Okay. So does my HSA contribution stop when I don't get paid because of the government shutdown? Yeah. So it looks like the government shutdown is going to continue for another week. They said they have no deal going on within the government. They don't see that happening this week, but they'll see what happens next week. And it's funny, like the government shutdown is about healthcare, but we're talking about healthcare. But yes, correct. Your HSA contributions will not be your paycheck will not pay into the HSA contributions if you're not getting paid. It doesn't matter if you're furloughed, then you're not getting paid at all. You're not getting back pay. So when you get that back pay, whenever the government decides to restart their operations, you may need to adjust your HSA contribution. So if you were contributing, let's say $200 and you're not getting paid on October 15th, okay, and you skip that $200 and then the government reopens and then you get that back pay later on, let's say October 31st, you need to adjust your contributions for the rest of the year if you're trying to max out your HSA. I am always maxing out my HSA, and I would hate it if I just missed out on getting to that 8,550 or 4,300 if you're a single person. So correct, you do not get the HSA contributions do stop. Same thing with the TSP. Same thing with anything else, but you're still going to be able to enjoy the healthcare benefits. Okay, good question. Another question from the private community. If my wife is 55 and I'm 55, I can do an extra 1,000 for each of us in the HSA, right? No. So this is the most disappointing thing about the big, beautiful bill. I was more focused on the HSA provisions. I'm not talking about the rest, but they had a huge HSA provisions in the big, beautiful bill. And I was excited for it because there were so many changes. And this was one of them. In the new bill, the original proposal was to allow both the husband and wife, the spouses, to contribute that extra $1,000 if they're both 55. Because right now, even today and next year, even if you and your wife or you and your husband are, you and your wife are 55, only one of you can make that extra $1,000 in catch-up contribution. It's BS. I think it's BS. I don't know why that rule exists, but it's just the way it is. But they only allow $1,000 for one spouse. In order to kind of go around that is you have to have two separate HSAs, kind of like my wife and I do. So my wife has an HSA and I have an HSA. And when she turns 55 and when I turn 55, she can make the extra $1,000 catch-up contribution at 55 in her account. And I can do $1,000 in my HSA separately. They have to be separate. But if you're in the family coverage plan, then no, you cannot do two $1,000 catch-up contribution, but instead you can only do one. All right. So good question on that. It sucks because that's one of the things that I definitely wrote to Congress about back in April. The HSA Enhancements Act, that is still sitting in Congress. Nobody's doing anything about it. I'm still looking at the HSA Modernization Acts. Nobody's doing crap about it. And it's just like, I feel like they propose a bunch of bills and they don't do anything with it. So you can probably hear my frustration on that. So, but anyway, hopefully that changes in the future. But there's just so much going on in politics. And I feel like Congress only does what's what people are watching. Um, if enough people really say complain about HSA, then maybe they'll make changes. But I don't know. It's very very disappointing. Okay. Anyway, uh, all right. So another question from the private community. My income is around 100,000 with a 401k match. If I put in 5%, awesome. If I can't do both HSA and Roth IRA, which one should I prioritize? I can't tell you what to do exactly, right? Because I need to see what your financial situation is. But let's assume that you're debt free, and let's assume that your expenses are low enough to get the 401k match, and then you have the option between HSA and Roth IRA. And it also depends on your tax rate too. Are you single or are you married? Because if you're single making $100,000 a year, your tax rates are already at 22%. And I don't know what state that you're living in, so that also depends too. If you're living in Nevada, you don't pay state income tax. But if you live in California, you got to pay higher taxes, just the way they are, right? But generally speaking, and I'll just say in my situation, when I had to decide between HSA and Roth IRA, I always chose HSA first. Hear me out. Because Roth IRA and HSA, when I compared those two next to each other, Roth IRA is after tax contribution, it grows tax free. HSA is a pre tax contribution and it grows tax free. So HSA alone is going to save us that $8,550 in contribution because that is all tax deductible. Roth IRA, on the other hand, that has $7,000 in maximum contribution limit. That's after tax. So if I had to choose, because my budget is constrained, my wife and I always say we're going to prioritize HSA first because the HSA contribution limit is a lot smaller for a family coverage. It really is. It should be a lot more. The 8,550 or 8,750 starting in 2026, they should be going up to like say 18,000. I feel like they should be matching the maximum out-of-pocket expenses, in my opinion, and that's going up to 18,000 next year. But they don't do that. They had that on the big beautiful bill. I'm going to bring that bill up again, but they erased that proposal. They had the expanded HSA contribution limit, and they just got rid of it. So I'm pretty sad about that. But if I had to choose, I always choose HSA first. But in your situation, it really depends on your filing status, what state you live in. If you live in California and New Jersey, you're not going to be enjoying that state income tax tax break anyway, because California and New Jersey still charge you state income tax when you put money into your HSA. But like I said, if you're living somewhere like in Nevada, then that could be a different story. So it really depends on what that marginal tax rate is going to be. Okay, good question though. Okay, another question from the private community. I am not sure HSA is the right choice for me because of my pre-existing health conditions. Is HSA really that worth it? Not when you have a serious condition. Now, I don't know what your conditions are. You need to take a look and see how much money you're going to end up paying out of pocket every single year. Because remember, this is a high deductible health plan, right? It's the complete opposite of what you're used to with the low deductible health plan. Kind of like when I compare that to TRICARE. I have talked to my wife about this in the past. We haven't in a while, but I did say that if something goes wrong with my body, let's say I got something crazy going on with my body that I need a treatment, then I said we need to switch out of the HSA and actually pause the investing with the HSA and switch my healthcare plan from HDHP to something more lower cost for the out-of-pocket expenses. But we need to kind of compare how much of that money is going to come out, because it's fine to pay, let's say $3,000, $5,000 a year out of pocket if we need to. We budget for that anyway. We got to pay for contact lenses, the dental treatments, braces for my daughter. There's so many things, right? So we budget for those. But if the bill starts to go up to, let's say, 15,000, 20,000, 25,000, then we're going to be like, all right, now we need to switch to healthcare plan. It just really depends, right? but that is a conversation that we had and said, well, if one of us really gets sick, or something happens to one of us, we need to switch out of our plans and we need to be willing to do that. And I'm okay with not contributing to the HSA if I have a serious health condition. But I don't know what your situation is. Maybe it's not, maybe you're not paying as much with the HDHP and you're okay because you mentioned pre-existing health conditions. But again, I'm not a doctor. I don't know how much money you're paying out of pocket. Just take a look at how much money you've been paying for healthcare. And this is where budgeting is so important, right? And I don't know why people are so turned off on budgeting. I haven't really been on TikTok, but I watched this TikTok video saying that budgeting is for boomers or budgeting is for the rich. I'm like, budgeting made rich people rich. I mean, only 20% of Americans actually inherited their money from their parents or grandparents, and the rest of them are first generation millionaires, and you have to budget. You have to know where your money is coming in and how much money is going out. You need to categorize what your expenses are. I have a YNAB link that you can use in the description below. I've been partnering with them for a while now. And, just budget and find out how much money you're spending on healthcare. I promise you, when you're 65 or when you're retired, it doesn't matter what age, I should say 50 or 60. At 60, your healthcare expenses are going to start to go up. Okay. And that's based on my experience with working with clients in their 50s, 60s, and 70s. Their healthcare expenses are by far the biggest. And I always suggest making sure that you set aside at least 15% of your budget for healthcare every single month when you're retired. You may not have to spend as much money on your transportation when you're retired. You may not have, you're probably not going to have to pay for schools because your kids are going to be out of the house. But you have to look at the next line item or the spending category that would be the healthcare. So, please track what you've been spending on healthcare. And when you're ready to retire, then you can look at your healthcare expenses in the previous year and try to figure out how much money you're going to spend in 2026, 27, 28. I do that with my private clients like all the time. You can go to firesightchat.com/private clients and you can sign up if you want to. That's more of a becoming one of my long-term clients if you want to. Okay. But good question, really good question. I need to talk to my wife about that again, about if our health conditions change in the middle of it. No. So yeah, we just talked about it. I do have a video on specifically about what got passed. So there were three sections in the HSA provisions that got passed, which is really it's nothing really. It just means that you can make a direct payment to the doctors. The bronze plan became an HDHP. Nothing else that matters to the most, like for everyone having a HSA, really made any changes. But I did make a video on that. You can check it out on my channel. You can search for Fireside Chat HSA. And I, just watch the latest video. Don't click on like the older video because the older video has me talking about what's being proposed in the big, beautiful bill. But just go to the newest video that I talked about with the HSA. And I probably should make a video separately about the HSA. I'll work on that. So just so that not everyone likes to, watch the live stream. I get it. I usually do a live stream for an hour. No more than an hour. Only for the Federal Reserve meeting, I do it for like 2 hours. But other than that, I try to keep it short at 1 hour and just answering questions. So, but check it out. There's a video on that. Why shouldn't I designate my kids as my HSA beneficiary again? Because the tax is correct. Yeah. So we talked about that earlier. If you're just tuning in, sorry. So let's say you have like $10,000 in your HSA, okay, and then you passed away. So remember, this is not taxed yet. So I'm gonna label that and say not taxed at all because you enjoy the tax deduction for every year that you put money in. So this money is going to be taxed, federal and state, when your beneficiary takes it. Not going to be penalized, but they will get taxed. So, but if you put it towards your spouse, it will just be a rollover. Think of it like a inherited IRA from your spouse's 401k. It'll just go into your spouse's HSA. So this is going to be tax free from Fed or state. But if you go into your kids, then this entire $10,000 will be taxed. So if it's going to be like someone under the age of 18, the court would have to assign a custodian because kids under the age of 18 are not going to be able to take that money and manage it on their own. So probate is most likely going to assign a custodian unless you have a will, because I talked about writing a will, right? Write a will and designate a alternate custodian if you pass away. If you're a single parent or if you're a single whatever, designate someone else to care for that person if you have a dependent who needs care for. But that 10,000, let's say your kid is 20 and making $30,000 a year in income. You have to add that 10,000. So basically, your kid's taxable income becomes $40,000. That's all it means. It's just that 10,000 going to your kids will be taxable, but 10,000 going to your spouse is not taxable because it just gets rolled over to an HSA. So that's why. I mean, if you're married, just designate your spouse unless you don't like your spouse for some reason. And if you're about to go through a divorce, then that's a different story. Again, like I said earlier, the horrifying story that I remember was someone designating their entire retirement accounts, investment accounts, still to his ex-wife. And I felt so bad for his new wife, or not so new. They were married for like 3 years. Did not redesignate his beneficiaries to his new wife. So there was a huge fight between the ex-wife and the late wife. It was just a mess. And I wasn't, this was a long time ago. It was like at least 10 years ago. But I just felt so bad. When he passed away, he was in the military. But anyway, just please update your will. I can't say that enough. I don't know why people don't do it. Okay, so let me go to the chat here. Yes, that's correct. That is a good one. The non-spouse beneficiary has 1 year to pay any outstanding medical bills for the deceased. So most of the time, however, they do forgive those. So whoever is taking charge of the person who passed away can contact the hospitals. The hospital bill will still be there if you were sick for a while. But you could use that HSA to cover the medical expenses to pay for the remaining hospital bills. But you can always ask for a discount. This is one trick that a lot of people don't know. Whenever when my daughter got her braces, it was like $3,000 out of pocket, right? So I called, and I do this every single time. I called the dental clinic and I said, "Hey, listen, I know you're giving me the payment option, like $200 a month or whatever. If I give you all that money in cash right now, would you lower that from 3,000 to like give me a 10% discount?" And they did. They lowered that down to $2,700. So every time you have a medical bill, call them and negotiate and say, "Hey, if I pay you in lump sum because you have money from your emergency fund or whatever, see if you can get a 10 to 15% discount." Most hospital bills or the billing department, they don't want to deal with all this delinquencies. If you look at the medical bills, right, in this country, it's a disaster. A lot of people are delinquent or they're not paying them on time. So in order for the hospitals to get that revenue, they would rather get that cash now instead of giving you the payment plan. So most of the time, they will give you that discount. I haven't had anyone say no to me. I think some people did say no to my wife when she wants to see like a specialist or whatever, but she knows how to do that too. Like when I had to go see somebody about my lungs, it's like, all right, instead of paying you $1,000 for the next 6 months, can I just pay you in cash? And you're like, yeah, you can pay $900. I'm like, heck yeah, But it's just a trick that you should know. And Always negotiate with the medical people. Um, it's unfortunate that you have to pay so much for medical in this country. uh, yeah, 100%. If you're not that kind of person who likes to organize your receipts, I mean, it's a new habit that you can pick up. I'm not going to force you to do it, but that is one way to do it. I save all of my receipts from, my gosh, 5, 6, 7 years ago, and they're always there, right? And I have those receipts scanned so that I can reimburse myself with HSA in the future. So, yeah, for sure. Uh, I'm guessing you have the limited healthcare FSA. You can have a limited healthcare FSA with an HSA. I have to be very careful with my words here. So it's so complicated for no reason. Okay. All these restrictions are just BS. They're nonsense, but they have them. Anyway, you cannot have a healthcare FSA with HSA. Okay. However, you can have an limited healthcare FSA. Remember the word limited, like this person, Silent Bob, love your name. Limited HSA, FSA can be opened with an HSA because the limited healthcare FSA only covers dental expenses and vision expenses. That's it, not the medical stuff. So yes, you can buy glasses. Or I have contact lenses. I don't have a limited healthcare FSA because that is, I know federal government has it. The federal employees have it. Some companies offer that, but it's very complicated because FSA has like different categories. There's the dependent care FSA, which I had for my daughter until she was 13. And that dependent care FSA expires once she turned 13 because that's for before care, after care, child care, summer camp, all that stuff. That's all paid in pre-tax money. So that's nice. And then there's the healthcare FSA, and that's where people who don't have an HSA, that is strictly for spending purposes. And then there's the limited healthcare FSA that's only used for dental and vision expenses. So got to be very careful with my words here. And um, you should not get hit with the 20% penalty, but I want to make sure that whatever you have is an eligible healthcare expense, but just keep that in mind. Okay. I don't want to answer the question not knowing your entire situation, but you should not. But take a look at it, do your own research, and not just from my answer during the live stream. And yeah, great question though. Uh, yeah, I can do that. I do have there's a fire checklist that you're talking about. So you can actually go to the website. You don't even have to go to my, it's, there's a downloadable checklist. Let me see. You go to firesidechat.com/resources. Let me share the screen here. So you get all the resources for free. Not all of them. Some of them are paid. You have to pay some, like the TSP calculator, Roth IRA calculator, all that stuff. Like the specific ones, you'll have to pay for. That's a different website, different web page. But this is the fire checklist that we have, and you can go to firesidechat.com/resources, and you can always look at it. I always started with calculating the fire number, right? My fire number is really not that high because I'm going to have all these passive income sources coming in. But the first step you really need to do, calculating your fire number. Like if you're not the type of person who budget, I have met clients making $300,000, $400,000 a year, and they're massively in debt because they never budget. So I'll tell you this from my experience, and I can tell you for sure that it does not matter what your income is. If you don't control your expenses, you're always going to be broke. It's a fact. Okay. It really is a fact. If you don't like budgeting, too bad. Do it anyway. I'm gonna say that very bluntly. If you have never budgeted in your life, you're never gonna know what your fire number is gonna be. Not not for sure anyway. Not 100% fire number for sure, or definitively, whatever. But anyway, do your budget, get that rainy day fund, and get that employer match. Because I always say employer match HSA, Roth IRA, and then go back to your 401k or TSP and get to that 25% savings rate, And then once you get that figured out, because you can't possibly achieve step 6 through 10 if you don't have step 4 paid off. So I owe it. I paid off my $110,000 in debt back in 2015, December 21st, 2015. And I spent the next 6 months maxing out my emergency fund. That was 6 months of my expenses. I wasn't married then. And then I went to HSA and Roth IRA. I went to 401k. I was working in the private sector at the time in 2016 and all the way to 2022. So I maxed out my retirement every single year. And here I am. I'm staying debt free. I have been debt free because I have that emergency fund. So, but yeah, take a look at it. It's on that website, Ron. Yeah. Really just kind of like tracking all your expenses, and that's really what matters. Okay. Man, I have seen the brokest millionaires, and I have seen the brokest household income of $300,000 a year, and it's insane. It's really insane. They add up so fast too. They really do. When you have a $1,200 car payment, 2 of them. Okay, you got private school tuitions. That's their choices because they felt like they're making $300,000 a year. That's $2,000 a month, maybe more, $3,000 a month. Mortgage, biting more than you can chew, $5,000 a month, and then you got nothing left. And their 401k, nothing's going in, nothing's going into the Roth IRAs, nothing's going into their HSAs because they're biting more than they can chew, and they have never budgeted in their lives. They're fortunate to have that income though. It's awesome to make $300,000 a year. They're not dumb. People are not dumb and make $300,000 a year unless you discover some kind of, I don't know, a treasure on the, I don't know. I'm just thinking out loud, but I have always noticed that you can be very good at making that money, but if you don't know how to manage it, it can disappear so fast. It really can. But yeah, well, let me answer the one last question here. From the private community, I don't want to miss you guys out. No. So if I get an employer contribution for $1,000 from my HSA, is that going to be in addition to the total contribution limit? No, it's not in addition to the contribution limit. It is included in the total contribution limit. So if you get $1,000, that's awesome, but you have to subtract that from the total contribution limit for the year. So in 2025, it's $4,300 if you're single, and then going up to $4,400 next year in 2026. And then if you're a family, it's $8,550 and then going to $8,750 in 2026. So you need to subtract that $1,000 from either $4,400 or $8,750. And then you can contribute the rest on your own, but it has to count towards your HSA contribution limit in whole, not separately. It's not the 401k. 401k, you can put $23,500 and your employer can give you $7,000, or I have seen some tech companies that match 100% up to the contribution limit. Like, no kidding. They put $23,500 into their employees' 401k because they can, and, but yeah, anyway, just, it's not like the 401k. So, just make sure that you're accounting for that employer match, but really good question though. Yeah, but the Medicare premiums thing, it's really disappointing they didn't pass that law. The other law they had in the big beautiful bill was to allow Medicare enrollees, so people after the age of 65, to have an HSA. Right now, they don't allow HSA for people on Medicare after age 65. So that's another disappointing part. I really wish that they had done that for our retirees, but because I rather you just continue contributing. If I'm healthy, hopefully, knock on wood, if I'm healthy at 65, I'm probably going to delay collecting Medicare and or enrolling in Medicare, not collecting, and just continue paying into my HSA until I can't, So, yeah, just kind of wish that they had passed that in the bill. But anyway, really appreciate you guys being here. The next Q&A is going to be 2 weeks from now, but I'm still going to have another live stream next Wednesday. So always Tuesday live stream this week, and then Wednesday the week after. I'll talk more about cash management for the next one, on how to manage your cash during your FIRE journey. And the one after that, I'm going to talk more about the different types of FIRE that we have. There's flamingo FIRE, which I don't really pay attention to, but there's like coast FIRE, that's really interesting, right? Lean FIRE, fat FIRE, chubby FIRE, and all the FIREs that you can have. But the ultimate goal: start budgeting, write your will, designate the correct beneficiary, so that your family doesn't have to deal with not just losing you, but also creating the headache, the logistics that they have to deal with later on. So please do so. But anyway, really appreciate you guys being here, and I will see you guys back in next week. And I have a new video coming out tomorrow as well. See ya.